Hey folks, I'm Jenny Wilson, and I serve as the Director of Financial Planning at Saylor Financial. We've received some questions lately about the CARES Act, and I wanted to take a moment to talk about a specific provision of the Act that relates to required minimum distributions and taxes. A little bit of background about required minimum distributions, or as we call them, RMDs for short. An RMD is the minimum amount you're required to withdraw annually from tax-deferred accounts, like 401ks and IRAs, once you reach a certain age. Because those accounts have special tax treatment, like pre-tax contributions and tax deferral, the taxes owed have been delayed for years and even decades. The longer you wait to withdraw the money, the longer it goes without being taxed. But the tax bill can't be delayed indefinitely, which is where RMDs come in. The IRS requires that IRA owners take withdrawals and subsequently pay taxes once they reach their RMD age. That age is 72, thanks to a legislative change that went into effect earlier in 2020. However, if you were born on or before June 30th, 1949, your RMD age actually falls under the previous rules, which is age 70 and a half. Now, typically if you don't take your RMD, there's a penalty of 50% of the amount that you should have taken. It's pretty hefty. But this year, the CARES Act includes an RMD waiver. So if you normally have to take an RMD, you now have the option to take a lesser amount or forego taking your RMD altogether in 2020. Doing so lowers your taxable income, which in turn lowers your tax bill. Of course, this really only works if you have other resources to support your spending needs, like Social Security, a pension, cash, or other investments. And you don't have to take a withdrawal from your 401k or IRA account. If you are in a position to reduce or forego your RMD in 2020, it may open an additional opportunity to use that freed up tax savings to do something called a partial Roth conversion. Roth IRAs differ from traditional IRAs in the sense that they're built on after-tax contributions. And as I mentioned earlier, traditional IRAs are built on pre-tax contributions. Both accounts still receive tax-deferred growth, but Roth distributions, they're tax-free. So even though the money added to a Roth was taxed, all the growth inside the account has been sheltered from taxes along the way, and when it's distributed, no taxes are due. Now that we understand some of the primary differences between a Roth IRA and a traditional IRA, let's talk about the Roth conversion itself. Simply put, a Roth conversion is a transfer from a traditional IRA into a Roth IRA. It's pretty easy, but there's always a catch, and the catch is taxes. When you move funds from a traditional IRA into a Roth IRA, it's considered a taxable event, and it's included in your taxable income for the year in which it occurred. But paying taxes now and moving the funds into a tax-free bucket could be advantageous, especially if you have a large 401k or IRA, and if you believe tax rates will be higher in the future. It's worth noting that to take full advantage of this strategy, the tax due should be paid from a source outside the IRA. In other words, having no taxes withheld from the transfer and paying the taxes out of other assets like cash on hand or a taxable investment account allows the full amount to be converted into the Roth. If you choose to do a Roth conversion, the amount you transfer is completely up to you. Just remember that you'll owe taxes on the converted amount, so it's really important to be aware of other taxable income you may have. You don't want to accidentally push yourself into a higher tax bracket and be surprised come tax time. Another consideration is Medicare. Medicare premiums for Part B and Part D coverage are income driven, and if you cross certain income thresholds, you'll find yourself subject to higher Medicare premiums. All this to say, 2020 presents a unique opportunity when it comes to tax planning related to RMDs and Roth conversions. Talk with your financial planner or your tax advisor about how these strategies may apply to your specific situation. If you'd like to know more about me or Sailor Financial and how we work with individuals and families, head to our website. We're at sailorfinancial.com.